What if I told you that your brain is hardwired to destroy your own investments? That the same instincts that have helped us survive for millennia are quietly sabotaging your wealth? Most of us think we know the basics of investing: buy low, sell high, be patient. Simple, right? But the truth is far more uncomfortable. Study after study shows that the average investor performs significantly worse than the market, not because they lack intelligence, but because of invisible psychological traps. In this video, we're going to uncover the brutal truths about investing, the mental errors that drain your account, and most importantly, how you can protect yourself from yourself. Fact 1. Your biggest enemy is. You first disturbing fact. Investing isn't about math. It's a battle with your own emotions. You can study financial statements and track every market headline, but none of that matters if you panic at the wrong time. The stock market is engineered to provoke your deepest instincts: fear and greed. When prices crash, fear says, sell. When stocks soar, greed yells, buy more. This isn't just theory. Dalbar's QAIB studies consistently show that the average investor underperforms the market, often by a wide margin. For example, in 2018, when the U.S. stock market dipped 4.4%, the average investor lost more than 9%, not because of the market, but due to poor timing. Constantly checking your portfolio is like stepping on a scale every 5 minutes while dieting. You get emotional whiplash. The more often you react, the more likely you are to make a mistake. And ironically, overconfidence makes it worse. The more certain you are, the more risk you take, and the less likely you are to follow a disciplined plan. The solution: build a strategy before emotions kick in. Define your goals, risk tolerance, and time horizon. Automate your investments, like setting up a fixed monthly transfer into a global index fund, and avoid overmanaging. Your job is not to beat the market, it's to avoid sabotaging yourself. Fact 2. The pain of loss is twice as strong as the joy of gain. This truth won a Nobel Prize. Daniel Kahneman and Amos Tversky found that we experience losses roughly twice as intensely as equivalent gains. This is known as loss aversion, and it distorts everything. You might hold onto a losing stock for far too long, not because it's smart, but because selling feels like failure. At the same time, you may sell winners too early to lock in gains, missing out on bigger growth. Important note: not all falling stocks should be sold. Long-term investing often includes volatility. But if you're holding a company with declining fundamentals, it's simply because you're emotionally attached. That's when loss aversion becomes costly. To fight this, stop anchoring to your purchase price. That number is history. Instead, ask, would I buy this company today at this price, knowing what I know now? If not, reconsider your position. You can also create rules, like rebalancing your portfolio annually, to remove emotion from the process. Fact 3. You seek confirmation, not truth. Here's another hidden danger: confirmation bias. You don't just look for information, you look for validation. You read articles that support your investment thesis and ignore anything that challenges it. You buy a hot stock and search why Tesla stocks will 10x. You feel smart when you find others who agree, but you skip the critical analysis. Dissenting opinions feel uncomfortable, so you filter them out and miss real risk. This mindset is dangerous. You're building an echo chamber, and when the downside hits, you're unprepared. Solution: be your own devil's advocate. Look for why your idea might fail. Read bearish takes. Write down at least 3 reasons your stock could underperform. It's not about changing your mind constantly. It's about making fully informed decisions. Fact 4. Complexity is a trap, not a strength. The financial industry profits by making investing seem complex. Fancy-sounding funds, hedge strategies, leveraged ETFs, they sound sophisticated, but often come with high fees and opaque risk. The irony? Simple wins. Time and again, low-cost index funds outperform actively managed alternatives over the long term. In fact, Warren Buffett famously bet that an S&P 500 fund would beat a basket of hedge funds over 10 years, and he won. You don't need to be an expert. You need to avoid the traps. If you can't explain your investment in 2 minutes to a 10-year-old, you probably shouldn't own it. If you want more honest, evidence-based content about money and mindset, hit subscribe and join us for the next video. This is Growth Minded. Thanks for watching. Give your future self a chance.